are still watching the CNBC Africa MPC special of the South African Reserve Bank's latest call on interest rates. First call on interest rates, of course, for the year being no change, repo being held at 8.25%. I am joined by Godfrey Mutizwa in studio, who's going to help me get through exactly what we should be knowing about this statement, of course. Learn anything new?
I got the sense that he delivered exactly what the market was looking for. And
the rand did nothing, so probably, yeah.
He was also making the point to Annabel as you were listening that he looked very relaxed, and she made the point that it's probably because there was complete unanimity in the discussion, and therefore it was not hard, may I say it, to reach sufficient consensus.
Okay, we'll unpack what that means for the purpose of the view in just a short while. But you did prelude Annabel, and of course he is talking about Annabel Bishop, the chief economist over at Investec, who joins us in studio, along with Johann, chief economist over at Old Mutual, and Carmen, now head of multi-asset strategy at Terebinth Capital, to help us dissect the MPC statement. To all of you, good afternoon. Annabel, beginning with you in studio, because you and the governor were matching. He was wearing a floral green tie. And I'm just wondering what kind of memos were exchanged and ultimately what this meant for interest rates. But jokes aside, your key takeaway?
You know, I think it's quite a relaxed start to the year. The United States is not expected to move on its interest rates anytime soon. Inflation is still very elevated from where the SARB would like it to be. They specifically made the point again, they wanted to be at 4.5% for a sustained period before they really look to cut interest rates. And I think, you know, from that perspective, we haven't had any recent crises. Looking forwards, you know, the economy is rolling out as expected. So really, I think, you know, that's why there just haven't been any market surprises, market reaction. And of course, you know, we're really waiting to see how the global economy unfolds. I mean, for us in South Africa, that's a particular risk. Of course, also what the FOMC does. And, you know, markets are really expecting a May interest rate cut. For South Africa, that really pushes us to a July cut, but also, of course, as well for our inflation outcome. You know, inflation is really only likely to reach 4.5% in July. You might say to me that's not a sustained period, then it might only, you know, result in a September cut. And of course, you know, that obviously is the risk, this desire to see inflation anchored back at the midpoint of the inflation target, because it's become unanchored for so many years.
I mean, I think that you said something quite poignant in the sense that the SARB, or the US Fed rather, is not expected to move anytime soon. And it is speaking to the perceptions that the South Africa's Reserve Bank tends to follow what the US Fed does. Claims that the governor, of course, dismisses at all opportunity that he can get. But there was a question as to the state of the South African economy and what it looks like right now. In fact, the South African Reserve Bank also revising down its forecast for 2023. There was reference made to the fact that households' incomes are under pressure, just in light of the cost of living crisis and everything that has gone around. So an interest rate cut before the US Fed moves would really be helpful for consumers here in South Africa. So perhaps maybe help us understand better why it is all about what the Fed does first.
You know, I think, while, you know, it is quite right that the United States and the South Africa relationship between interest rates doesn't mean that South Africa blindly and blanketly folds everything the United States does. It obviously will choose to differentiate if there's a need to differentiate, if there's a requirement to differentiate, if things are different here than they are there. But, you know, with inflation not a target, with it not anchored, and you can say the same in the United States, there are these similarities which obviously come through. Weak growth expected in the US this year, in South Africa, you know, weak growth at 1.4%, you know, seems stronger than last year's 0.5%, but it is still weak compared to the 4 to 5% that we really need, or above that, to really reduce unemployment. So to look at the timing of an interest rate cut in South Africa, if we saw inflation come down quicker and be sustained, you know, that would be key, because for the South African Reserve Bank, and as the governor said when he was speaking just now and answering questions, for them it's all about inflation. It's all about targeting inflation. It's all about inflation expectations. And yes, while the economy is not pushing through demand side pressures and pushing up inflation, and, you know, there's no push from that side, and that also of course means it's very unlikely to see any tough interest rate hike. It doesn't move us away from the fact that while the economy is weak and we'd appreciate interest rate cuts, it's not appropriate in terms of their mandate, their view, their very severe focus on inflation, because at 5% as an average for inflation this year, it's not where they want it to be. They want the year to average 4.5%, and that's why I think, you know, there's that strong hawkish tone coming through in the commentary and from the Reserve Bank Governor in his speech, but also, of course, as well, just really, you know, placing us back behind really where we need to be, that we just, you know, they want to see this 4.5% achieved, and they want to see it sustained, that anchoring of inflation.
Yeah, and I like the way he turned the argument around and said, this is not really about us monetary policy decision makers. This is about the public, which wants to see the cost of living coming down. Let's take the conversation to Johann. Johann, did you hear anything new in the governor today that suggests that what the market is pricing in terms of when that pivot will come is likely to change?
No, I didn't hear anything new, so I am in agreement there. I think as expected, as everybody has said, and I think that's what we expect from the central bank, to be conservative, to warn about those inflation risks. And there certainly are a number of risks out there. But I think that perhaps inflation, the easing that we're seeing, is a bit faster than what the Reserve Bank is willing to admit publicly. They see the numbers, but in terms of the commentary that we heard this afternoon, very hawkish statements around that easing. And I don't agree that we need to see inflation on average back at 4.5. I think it's the monthly trajectory and the underlying trends, the shorter term, seasonally adjusted, 3-month annualized type of trends that the bank is clearly also watching. I think that the risks certainly are there that rate cuts come later than what we want as consumers in South Africa. But I think that there is a likelihood that rate cuts can actually start from around March. Given the way that I look at inflation, I think the governor warned about inflation expectations, and certainly that's one of the reasons why he sounds hawkish about the inflation outlook and the inflation risks. But I think those inflation expectations follow actual inflation. And I think over the next few months, we'll see actual inflation heading towards below 5% and closer to 4.5%. We've seen in the past that these hawkish statements around need to see inflation around 4.5% on a sustained basis. I absolutely think the bank can and might very likely move before we see that sustained around 4.5%. And I agree that we're not necessarily going to wait for the Fed. I think our inflation, and that was a comment there that the bank has made before as well, that our inflation has performed better than many other countries across the globe, peaking lower, less follow through from supply chain issues, etc. And of course, some of that is because of a very weak economy. The pass-through has been limited. Companies had to absorb the costs in their bottom lines. So that has been helping. And I'm certainly in agreement that that weak economy is not going to change anytime soon. So I don't see a significant faster pass-through. What I'm saying is, yeah, there was nothing new, but I think that we can very likely see a scenario unfolding over the next few months where the Reserve Bank might be in a position to start cutting rates from March onwards.
Actually, I was going to come back and pick up on that, but I wanted to ask the question, do you think the hawkish statement that we got today is a return to Tito Mboweni and his open mouth operations, i.e. try to manage people's expectations so that they behave accordingly, and hopefully that will quicken the path to softer interest rates? And then the second part to my question was to ask if you are saying that if you were governor, you'd begin cutting in March.
So absolutely, I think it's open mouth operations. I don't think it's a new thing, or return to that. I think this governor has in the past also followed that policy. Now, I totally believe that that's a correct policy. Talk tough, then perhaps you need to do less. So absolutely, I agree with that. Yes, if I were governor, of course, I need to watch the data over the next few months. We've got a couple of inflation data numbers coming out before the March meeting, which is only on the 27th of March, so towards the end of March. And we'll have the February inflation number by that time. There's some upside risks, but even on food side, it seems the El Nino effect is petering out a little bit. Soil is damp. Good rainfalls towards the end of last year. I don't think that effect is going to be as severe. It seems that oil prices are relatively stable the rand is probably at its weakest and probably can stabilize, be a little less weak over the course of this year. So fuel prices are also likely to perform better. Yeah, if the numbers come out over the next few months as I expect them to, as a governor, I will cut in March.
Carmen, bringing you in here. I mean, just taking a stock of what the rand is doing. We're having a party in the studio. Okay, back to business. Taking stock of what the rand is doing right now. 1888 to the US dollar, suggesting that the rand also feels like there was nothing really new that the MPC delivered today. Just your take on that, and whether the market at this current level in time is pricing in for a March cut, like Johann has suggested, or perhaps a cut coming in the second half of the year, which is what most commentators that we speak to on the channel have suggested. Your take?
Yes, if you just look at what the forward rate agreements are telling us, they say the earliest that a cut could come through would be in May. So not overly late, but certainly not as early as March. I think what plays into that partly at least is what happens to the market pricing of what the Fed will do. And we had today's fourth quarter US GDP data out at a very robust 3.3% when the consensus was 2. So I'm sure that will also push Fed expectations outward slightly. I think that the Fed is a potentially necessary condition in terms of putting in a firm pivot to open the door for the Reserve Bank to comfortably cut rates. So I think the SARB will rather follow the Fed than actually risk easing if there are ongoing vulnerabilities to the rand. So waiting for the budget, the SONA, those are important drivers of rand risk. So currently stable, but things could change if the budget isn't market friendly, which certainly is not our base case. We actually think the budget will manage to hold the line.
So let me tell you a little bit of a story about Johann Alsen. Perhaps he can come through also after this question. There was a time when he had one of the most optimistic forecasts for growth for the South African economy. In fact, he was in his own lane, kind of like what is the case right now in terms of rate cuts. And he expected the South African economy to perform a lot better than it did. Everybody was most people were less optimistic. Towards the end of the year, what we did see is most people revising their forecasts in line with what Mr. Els had said. And so now he's again in his own lane where he's expecting a March cut before most commentators that we're talking to. I just want to know, Carmen, in the event that Mr. Johann Els is correct, it's possible, however likely, I'm not too sure, but possible, then the market does what in terms of repositioning?
Well, certainly I think so. The market is not positioned for a March cut currently, even in the US as well as here. That would obviously, a cut would steepen the curve somewhat. It would certainly boost equities, looking at sort of the domestic orientated sectors, because the equity market would really like to see cuts because we know growth domestically is strained. The SARB's trying to sort of argue that the policy stance is aligned with the inflation risk, but policy is currently quite tight, and we know actual GDP growth is low. We know it's low in part because of the things the Reserve Bank cannot control. So sort of we need to think about the SARB as the country's risk manager. And that's the position they're taking, whether it is in not cutting, using open mouth operations. And I think what's also important is that easing in terms of the nominal interest rate may just imply the real rate stays stable, which would also have an impact on the market. So it doesn't necessarily boost growth beyond a minor sentiment story. And a weak or the impact on the rand will then very much depend on what everyone else is doing. So if we are easing slightly, our growth is doing okay, and our fiscal risk is dissipating, which I think is also a key input into the SARB being able to cut rates, then the rand will hold steady, might even rally a little bit because of dissipating fiscal risks. But then we know a currency is a two-sided price, so we'd have to see what is happening, for example, in the US. Is the US also turning more dovish? Will that then put pressure on the dollar, allowing the rand to rally further? So our base case is also that the rand is somewhat undervalued. We'd expect some modest appreciation to come through this year. But I do think uncertainty is still pervasive, and a lot in terms of a positive or negative shock really is going to come from offshore, and whether the global economy sort of stabilizes, or we do get a massive slowdown. So far, the US is definitely bucking the narrative about a slowdown in the first half. So that's certainly a risk to watch, because US yields could stay quite high, which then speaks to that tight financing conditions that the governor referred to in the statement.
Absolutely.
Do you remember that time?
Yeah, I do. I was actually going to say that he announced it to us. We got the exclusive on that story, by the way.
It was 2% growth for 2022.
Absolutely, and he absolutely nailed it. But let's hope that he's also right this time. Annabel, I wanted to come to you, and while we're beating the drums for that red card, which is going to come, when is the question? But many are saying perhaps we are forgetting that even though there might be cuts coming along, it might not be much. What are you pricing in?
So our first interest rate cut is a 25 basis point cut. And of course, you know, if we do see an earlier cut than the second half of the year, a lot will obviously depend on what the South African Reserve Bank forecasts in terms of its inflation. So it's not about where inflation is, because inflation is historical.
Yeah.
So today, obviously, we're sitting in January, but it's December's figure, that's the latest one. So the Reserve Bank cannot influence that by changing its interest rates. So instead, it's what its inflation expectations are. They look out to a 6 to 24 month period, but particularly 12 to 18 months' time. Now, over 12 to 18 months' time, we see inflation not only remaining at or below 4.5%, but in fact in the second half of the year it could actually dip below 4.5% and actually dip towards 4%. And of course you will know that that's base effects from high inflation last year, and of course as well, you know, we do have some currency strength in our forecasts, because obviously when you do tend to see the United States move into an interest rate cut cycle, you do tend to see emerging market currencies strengthen, and of course that's because you do get a lot of foreign appetite for portfolio assets, bonds and equities of your emerging market countries. So, you know, that's why we are, you know, saying that, you know, the risk obviously, if we were to look at the interest rate path, is for an earlier cut. But of course, again, you know, the Reserve Bank coming out with a 5% average for inflation this year, and our average incidentally is 4.5%. They're playing on the cautious side. If they had an average of 4.5%, and they obviously then had a lower inflation the second half of this year, and combined with their forward-looking inflation targeting approach, that would really signal an earlier cut.
What would be the quantum though? Really, I want to know how low we can go, because many people are suggesting that this will be shallow. This probably, I think one thought I saw was what, 75 basis points? What's your forecast?
So we have a 125 basis point cut in the entire cycle, but we're only expecting 50 to 75 this year, and the remainder next year.
So we're not going back to normal.
Well,
as in what
normal
we were used
actually is about 2 to 2.5% above your midpoint of your inflation target range. So if you're at 4.5%, then you know you're really looking at 6.5–7% for your repo rate. We got used to a repo rate of 3–3.5% during COVID. That's not normal. That's excessively loose, excessively supportive monetary policy to help in a very difficult period. You know, moving back to a normal inflationary period, which obviously you would have if you were running at 4.5% and inflation expectations were obviously anchored, then you would look at that neutral real interest rate. And of course, you know, the South African Reserve Bank has been at pains to say it really is 2.5%, dependent very much on country risk. So if things deteriorate, which we don't expect, we expect to see that the South African government will hold the line in terms of its debt forecast, which is obviously the most important thing when we have the budget, debt as a percentage of GDP, and of course its fiscal deficit as well. But really, you know, debt as a percentage of GDP has increased in terms of the MTBPS. We think they might be able to pull it back a little bit, but nevertheless, country risk does blow out. In other words, you need higher interest rates if you move into a worse government finance environment.
Let me remind you that geopolitical risk is real, and South Africa has been drifting, some suggest, to the east more than it has been staying cool and keeping market supported as we have traditionally done, expecting that if they start cutting in the US, some money will come here. But if the politics continues to go, it's going, who knows? That factor, let's park it. Let's
park it.
See.
And let's get Johann's forecast.
Yes, I wanted to see if we can build sufficient consensus on what that cut.
Save me now. Save me now.
How deep that cut is likely to be.
So, Johann, just picking up on what Godfrey has said. So, Annabel is forecasting a 75 basis points cut for 2024, 125 for the cycle, and it's similar to what Bank of America also told us earlier on the show on Power Lunch. FNB has 75 basis point cut in its forecast. Standard Bank a little bit more optimistic in terms of the interest rate cuts we could see. They've got 100 basis points. What say you, sir?
It's neither here nor there because it's also close, I think. Mine is 100 basis points in cuts for this year and another 50 for next year. So it's very close to what other people are expecting, perhaps 25 more. But that's the type of trend, and I agree, it probably won't go much further than that in this down cycle that we're expecting. But if I may, what was surprising and probably needs to be celebrated is that it looks like all three of us broadly agree that the rand can come back a little bit, and I think that's unprecedented that three economists agree. But I think the rand can come back. Currencies overshoot always. But in our environment, leading up to the elections, and with, as Carmen said, the uncertainty around the budget, we'll probably see lots of volatility as we normally do. But yes, I think the currency can strengthen quite a bit from oversold levels where it is now. And that will certainly help that inflation outlook. On inflation, I also expect 4.5% average for this year. And that's why I've got 100 basis points in cut in this year and another 50 next year. So 150 in the cycle.
I want to challenge all of them because all of them, so maybe with a few exceptions, but all of them, as we got towards the tail end of 2023, were suggesting that the rand was going to strengthen. It's just that I can't pull up the numbers now in terms of what the ranges I got, but that strengthening didn't happen. What's the probability that it won't happen given our politics and our elections?
So a couple of things. The reason why it didn't happen, remember, is that the US kept pushing out its interest rate cut expectations in its communications to the markets by really strongly communicating higher for longer. For country risk, it's really a bond yield calculation. It's not so much in terms of who you are friendly with or not friendly with. So that obviously is one of the key factors for the South Africa interest rate outlook. If you obviously have a look at our geopolitics, South Africa obviously has gone to the ICJ in terms of supporting Israel, and as we know, and supporting Palestine and not Israel, and as we know, the United States supports Israel. So that's where we are finding ourselves in terms of geopolitics with the Israel-Hamas war. Obviously, we find ourselves in a situation again where South Africa, even though it feels it's neutral, has been seen to be more supportive of Russia than it should have been as well. So this talks to a go. It talks to do we lose a go or not, and that's obviously that free trade agreement is a legislative bill with the United States.
Decision is sometime this month. Sorry, I just remembered.
And that obviously is quite important for the rand as well. So many factors that actually feed into the domestic currency. We continue to think that when the US starts its interest rate cut cycle and continues it, it really will have a positive effect on the rand. We go below 18 rand to the US dollar. We've got the rand in the 17s. And let's not forget it did do that last year. And of course that again was on market expectations of US interest rate cuts. You get exuberance in the market. The Fed talks about irrational exuberance. You get this forward-looking approach. And of course the Fed has recently communicated that they're concerned that the markets might be factoring in too much in terms of the rate cuts, because that obviously then leads to stronger GDP growth, more inflationary pressures. So you can see how there are just so many factors that obviously are involved. But just to really answer your question on the exchange rate, we really continue to think that it's most likely that when you go into a US interest rate cut cycle, you do see the rand and other emerging market currencies strengthen. We've lost so much on the currency, it could actually run stronger than expected as well. That's also happened in the past.
Sure. Carmen, your thoughts here? I mean, fine, the US Fed cutting cycle could be a potential benefactor for the currency. I want your take on commodity prices, because I mean the SARB governor did highlight that commodity prices fell 27% last year, expecting another 12% this year. Could be more, depending, of course, in my view, of what happens in China. And we know that China has been quite the market laggard, and as a commodity-based currency, your forecast of where the rand goes and to what degree what commodity prices do, to what degree could that offset any potential gains that we could see?
Well, I think just on a weaker dollar alone, we should get to just below 18%. So that, as you said, is the positive. It's difficult, I think, to sort of put all commodity prices in one basket unless you believe that there will be a marked global slowdown this year. So if there's a marked global slowdown with global growth already below trend, then you can have broad-based commodity weakness, which will then offset some of the dollar weakness, unless you basically get what's called the dollar smile. So if there's risk off because of global growth weakness, then the dollar could find a bid. But so commodities can be quite mixed. For example, gold could be underpinned if the Fed does cut rates and real rates fall. Then gold would be supported, which would be positive for the rand. There's sort of a nice sweet spot in terms of the link between the rand and the oil price, where growth is not too hot. So if we even have oil recovering to something like 85 to 90, that would also signal that growth is actually holding up. And while we are a commodity currency, it does mean we're also a beta on global growth. Then that will also be positive. So I'd be cautious to have sort of a very blanket view on commodity prices. Food prices should continue to slightly stabilize, good for food price inflation, good for demand in that sense. But we know food prices aren't a key driver of SA export prices, but rather contribute partly to import prices. So I would be careful to be overly bearish from these levels on commodity prices. And I think there are a lot of sort of sector or market specific factors around supply chains, capacity, etc., that could actually underpin commodities in the medium term. In terms of our expectation on the repo rate, we've got 100 basis point cut for this year starting in May. So again, broadly in line with the consensus and maybe a tick ahead of what the market's currently pricing.
All right. Sufficient consensus.
Sufficient consensus. 175 to 125 basis
150,
points.
Johann.
I thought you said
Johann, 150, right?
150. Oh, wow. He's
In the
quite
total
a
cycle, yes. 100 this year and 50 next year.
Oh, wow. He's quite a dove.
Sufficiently insufficient consensus. But what I can say is that we are sufficiently out of time. We thank you, of course, always for watching. Any final words?
Yeah, absolutely. I think from my perspective, it will be interesting to watch the market repricing things, especially given the bloodiness that global markets have gotten from the Fed. Everybody was talking about the first quarter in the US, and here we are. We're now talking May as the key month to watch.
Right. Well, that means you'll have to continue watching the channel, of course. But a big thank you also to our economists, Johann from Old Mutual, Annabel from Investec, as well as Carmen now joining us there.